All right, welcome back to Robinhood Stock Market Watch List. My name is Carlos, and today is Sunday, December 18th. We are going to go over a lot of the scheduled events that are going to provide a lot of volatility this week. Now, next week is the next following week after this one is a holiday week. So typically we'll also see a lot of bearish activity, but a lot of low volume as well. Basically, this week is pretty much the last week of major economic reports for the year or the quarter, as well as the earnings season. And so the next following week after this one, we should see a very, very little activity, because a lot of investors in Wall Street are pretty much going to be, on vacation mode. So just be prepared for the next few weeks. I won't be able to do the meeting next weekend because again, it's a holiday weekend with Christmas and everything. So but obviously we're always around 24/7 in our group chat. So but let's dive into this week's economic reports, because economic reports always have the biggest impact on the entire stock market system. So it's always best that we start there. And we usually use investing.com website or their application from your app store to utilize that information. And so here we are in the economic calendar. We just have to reconfigure some of the settings under the filters area. We want to clear everything. There's only two things we need to see, and that is a check mark under the United States, and then under importance we will see a 1 star, 2 stars, and a 3 stars. We want to put a check mark under 3 stars because that's telling the website or the app that we want to see everything that'll have the biggest impact on the United States stock market for this week. We can see that there's a pretty nice decent amount of major economic reports that will have a big impact on the stock market each day, except for Monday. Now, normally we see these economic reports scheduled for a Tuesday, Wednesday, and a Thursday. Very rarely do we ever see them scheduled for a Monday or a Friday. But in this week, we do have some scheduled for Friday, which is great. We love volatility. It provides us great opportunities. So Monday, there is not anything scheduled except for some earnings. And but tomorrow, or Monday, the December 19th, could be kind of a recuperating day from the last several bearish trading days that we've had. And so or it could just be maybe it just range, maybe it's just going to be flat, and or maybe investors are going to continue to provide fear in the market, and we'll see more bearish activity. I think that we'll see either bullish characteristics as we will try to recuperate some of the losses that the market had from last week, because the market needs to come up before it can continue to come down. And that leads us into Tuesday, December 20th. We have the building permits for the month of November. And that's pretty major because there's usually, quite a bit. Now, it's also important to pay attention to the time that these economic reports will be released, because they are being released while everyone else is watching it. The news companies are watching it, Wall Street is watching, and they're reacting to it as soon as it happens. Now, this is the reason why we don't want to rely on news companies and news applications, is because the whole thing would be delayed, because they're getting it the same time this is released. It takes them time to create an article, blast it out there to thousands or millions of other people, and that could take minutes, or it could have taken an hour for you to receive that information, when you could have just paid attention to when or what reports are going to be out, when they're going to happen, and also we can kind of predict how it will provide a reaction to the market. Will it be bearish or bullish? And for the most part, we always want to focus on the forecast and the previous, because the forecast kind of shows, is it going to be higher or lower than before? And most of these economic reports need to be higher than before. If they're higher than before, then that should provide bullish characteristics. If they're lower than before, they'll provide bearish characteristics. And there's only a couple other reports where they actually need to be lower. The lower the better, like unemployment or crude oil inventory levels. If these numbers are low, like example unemployment or initial jobless claims, people are working, they're paying taxes, that it helps the economy because they're buying things, and it just helps. Crude oil inventory levels, people are driving, consuming fuel, and that helps the economy that way, as well as if they're driving, that they're doing other things, going on vacation, shopping, whatever. And so it's just really important to know these things, as well as the times that these will be released based on your time zone, because when we're looking at on the website, by default it's going to be the Eastern time zone. If you're looking at on your mobile phone using the application, it's going to automatically configure it to your time zone. So it's important that you know whether this is going to be released before the market opens or after the market opens. In this case, for Tuesday, this report, the building report, is scheduled to be released 1 hour before the stock market opens. Since it's forecast to be lower than the previous, that means be prepared for bearish characteristics. So Tuesday could easily be a very red day. However, since the government is trying to crash the economy, Wall Street and investors know this. Sometimes the stock market may react to that bad news is good news. So in some cases, if we do see a bearish result, sometimes that could provide a bullish result, because and this is very rare that this happens, and that's why we want to focus on the majority. The majority of this type of result will provide bearish characteristics. But like I said, every once in a while, where the bad news is good news type of thing, because the investors is really waiting for the government to cool down interest rates, and when it comes to quantitative tightening, that's all scheduled, and that's pretty much well fixed. They can modify certain things a little bit, but nothing significant. But where the interest rate hikes, they have these decisions and they plan these things out, a little bit, as they go through these meetings, throughout the year. And so, but yeah, so just know that, Tuesday, for the most part looks bearish. And then going into Wednesday, we have 3 economic reports. Now, each one is scheduled to be released after the stock market opens. We have 2 of them that is scheduled to be released 30 minutes after the stock market, and then one is 1 hour after the stock market opens. Now, typically the first hour and the last hour of the day are the most has the most activity, the most volatility of the day, and it's amazing how they schedule these on purpose to provide a massive amount of volatility going into opening, as well as providing more volatility after opening, keeping that momentum going. And so it's just amazing how they do it, and they do it on purpose, just for this this kind of reason. And so it's very valuable that we take advantage of this. And so the CB Consumer Confidence Report. This is the report for the month of December, and we can see that the forecast is 101 versus the previous was 100.2. So this is scheduled to be, provide some bullish characteristics. However, we do have the existing home sales for the month of November. Now, if the neat thing about these is that, you know, when we're looking at it regularly on a daily or a monthly, or I mean a weekly basis, you know, we start to memorize, you know, what these are and what the previous reports used to be. And you know, it wasn't that long ago where the existing home sales, which is really, you know, used homes that have already been built, that have had previous owners, you know, this holds the majority of the sales compared to new home sales. Usually this is around, you know, 500,000. But previously, you know, before all those interest rate hikes, these existing home sales or used home sales were right around that 5 to 6 million sales per month. I mean, it is down quite a bit. If it was 6 million, I mean, it's down like a third. Or, you know, 5 million, I mean, it's down almost, you know, 20%. That is a huge chunk of the real estate, as well as, you know, the economic growth. And because that is just a massive amount of money, that a revenue that's you know, declining month after month, because people aren't going to get an interest rate with these I mean, get a mortgage with these high interest rates. And so, you know, it's interesting because the housing industry will do everything they can to try to fluff their numbers. They'll be like, oh, it's fine, the real estate, we're having, you know, it's fine, you know. I highly recommend you guys watch that movie called The Big Short. It had to do with the 2008 housing crash, though we're not really going to have that type of housing crash like then, but I still highly recommend that you guys watch The Big Short. And so because it just adds, well, because sometimes to understand things, something, it's good to understand the history of things, and sometimes history repeats itself. Now, one of the reasons why we had a housing crash is because we had the balloon payments. I mean, it's inevitable. If your mortgage payment increases every single month, of course there's going to be a housing crash. And so, but in this case, we don't have these balloon payments. So these are fixed mortgages that we have and everything here in the United States, and so, you know, payments don't go up. And so but we do have interest rate hikes, and that's going to prevent people from buying. We may see some foreclosures, but like I said, the housing industry or the real estate industry, they're going to try to do everything they can to, you know, to make sure that their numbers look as best as possible. And so but I mean, these numbers, I mean, who knows, these numbers could actually be, you know, lower. But like I said, they're going to try to keep these numbers as high as possible, making it look like it's not as bad. But the overall sales, though, will continue to decline as interest rate, and this is part of the goal for the government. So we could see, you know, where this type of bearish results could provide, you know, a bullish activity for the day, because, you know, investors are like, oh yeah, the economy's crashing, it's working finally. Because when we get into you know, next year during the you know, the summer season, or towards the end of the spring season, that's when we're going to see or basically that's when we're going to enter the bull season. No matter what anybody tells you, you know, this is part of a cycle, and we always want to follow the cycle, no matter what anybody says, because, you know, the cycle repeats itself every single year, or every 10 years, just depends on what type of cycle that you're kind of looking at. And so but we have about, you know, the next 3 months is going to be pretty hardcore, but because that's the peak of our bear season. And so but the second quarter is usually kind of flat. That's what I call the transitional period. That's going to be your April, May, June, and so it could be kind of flat as we get closer into the third quarter. Then you know, the investors will begin to see the light at the end of the tunnel, meaning where the interest rate hikes will either have stopped, or really slow down significantly, but also quantitative tightening will significantly have been greatly reduced. And so investors, including all of us, are basically going to see the light at the end of the tunnel, where we're ready to pump up the market as fast as we can. And so the market is really going to gain a lot of the losses that it had in this long period of time, but in a very short period of time. And so but we're getting kind of ahead of ourselves, but it's always nice to kind of know what's going to happen before it happens, and that's why we have these meetings. And so but yeah, so just be prepared that these are major economic reports that are going to provide significant volatility for these days. And the way you can level out the volatility with these reports is that the more rare that they are, the more volatility that it's going to provide. So if it's a weekly report, like crude oil inventories, unemployment, it's going to provide a mild amount of volatility. If it's a monthly report, it's going to provide a lot of volatility. If it's a quarterly report, something that only happens once every 3 months, that's just going to provide a massive amount of volatility. But so far with Wednesday here, we do see one bullish forecast and one bearish forecast. Now the crude oil inventories doesn't have one, but this is a very, very easy one to predict regardless, because the previous report had surged straight up to 10 million barrels of oil. That means nobody was driving, or a combination of things. Nobody was driving or flying, as well as maybe our government was pumping more oil. I mean, and so the supply is high now. The supply is high, the demand is low for some reason. And that means that the gas prices are going down, and so that could be part of their process, the government's process of lowering inflation and stuff, by helping lowering fuel costs and stuff. And one way to do that is to flood the market with oil, and so that's what we're kind of seeing. But normally when we see that, and this is bearish. When it goes up, when people aren't driving, that doesn't help the economy, so that's bearish. These numbers need to be down. Even if they're in the negatives, that's even better, or bullish. And so, but normally when we see a big swing like this, we see a bounce. And so this surged up, it's going to bounce off of that high area, and it's going to come down. And so that will provide bullish characteristics. So we have two bullish economic reports and one bearish economic report for Wednesday, and so that's a little mixed. So one may dominate the other. We have two economic reports right here that are monthly. So I'm thinking that out of all of these, the existing home sales or the used home sales are going to provide the biggest impact, because of probably the revenue that it provides. And so but because it's forecast to be bearish, I'm still kind of curious if it will provide the opposite, bullish characteristics, because investors are wanting to. But we've already been through a lot of these, the Jerome Powell meetings and whatnot, and they've already said that the next interest rate hike is it was like the first week of February, and then I think the second one was in like the second or third week of March. So I'm not sure if we have. Let's go back here. Let's go. I can't go. Let's go here. Well, let's not worry about it. But anyways, but yeah. So just know there are two more interest rate hikes that are scheduled, and but as we get closer to March or the end of the first quarter, they'll be able to schedule out what the interest rate hikes will look like for the second quarter. And so, but because we are a long ways away from that, I'm pretty sure this is going to provide more bearish characteristics than bullish. So, so just be prepared. Most of us straddle, which is what I would recommend, straddling both calls and puts, because of the massive volatility will provide a great opportunity. And so Thursday we have the GDP report, which is the third quarter report, which is scheduled or forecast to be the same thing. So it's very hard with this being the same whether it will provide bullish or bearish characteristics. I would say to be determined. So I think the investors are really going to. This is basically economic growth. Did the economy grow during the third quarter, or did it decline? And so now when we click on it, any of these, it can easily provide us, some information on what it is and how it can affect the market. Sometimes down below we can see previous reports and stuff. And this is a major economic report that helps provide other information as well as other economic growth, but also, are we in a recession? And so for the longest time we were in the negatives, and so this was telling us that we are in a recession. But all of a sudden it bounced up and it said no, we're not in a recession. And so we could see some more activity with this. And so I would say to be determined. Everyone is going to be watching this very, very closely on Thursday morning, 1 hour before the stock market opens. And so unemployment, that's going to provide a very mild amount of activity. I would say bearish activity because unemployment is going up. But again, the government wants to crash the economy, and they also want unemployment to go up. But when we have what's called a population problem, there's so many jobs out there that are still struggling to find people to hire. And so, but when you have almost more jobs than the population, that's what we have, a population problem as well as population growth, because people don't want to have kids in this type of economy. And so there's a forecast in decline in population growth. And so and that's why the borders are wide open. They're inviting people over, even like people in Ukraine. Everybody's getting any Ukrainians that can come over. They're giving them a 2-year pass, and whatnot, and that way they can kind of and so there's just they're trying to get more people here, and that will help our economy now as well as the near and late future. And so history repeats itself. We've seen this. Ever watch that movie, The Gangs of New York? Very historical, events, but people, they kept, bringing people, foreigners over, from all over the world, and having them become an American citizen and being able to vote, and it helps the economy. And so that's what's kind of going on now, just but it's very interesting because even before the pandemic, unemployment would usually hover around 250,000, maybe 300,000. But I mean, these are very, very low unemployment numbers. And so it's very, very interesting to see, especially with all those layoffs and stuff that we hear. But yeah, just expect a lot of volatility on Thursday. This will be a great straddling day, so I highly recommend let's straddle both calls and puts, because we're going to see a massive movement in one direction. It's either going to go up significantly or it's going to go down significantly. And when it comes to straddling, a lot of people straddle Apple, Amazon, Tesla, maybe AMD, Nvidia, and when you're holding something into something that provides a lot of volatility, you can only lose what you have on one side, but your gains on the other side are potentially unlimited. So worst case scenario, you may lose maybe 100% on one side, but you may have gained over 100% on the other side. It could be 200%, it could be 500%, or even more. And so this is a great opportunity. So we have a great schedule that we can see here. And then going into Friday, we have two more economic reports that are scheduled to be released 1 hour before the stock market, and then another one 30 minutes after the stock market opens. But these are the core the core durable goods orders, and then the PCE price index, both for the month of November. Now, the core durable goods orders, we can see that the forecast is less than the previous. So it's telling us be prepared for bearish characteristics. The core PCE price index is scheduled to be the same, so also to be determined, but the new home sales is also expected to be lower. However, I don't know if it shows us any previous information on that, but it was very interesting to see that the new home sales have actually gone up, the last several months, where normally it was right around. Well, this is before they started doing major interest rate hikes, but you can see where the new home sales was up almost in that 750,000 area, and how it just kind of dropped down. Even in August, it fell down to 500,000. I mean, that is huge, but then significantly bounced back up, but it's starting to fall. But we can kind of see how it 1 month it's up, 1 month is down, and so that leads us into that next one should be down, and so and that's why they have a lower forecast. So it should be kind of probably within this area, but if it's less than the previous, even if it's higher than the forecast, be prepared for more bearish characteristics. So we got a lot of bearish characteristics with to expect for this week, with maybe a little bit of some bullishness in there, but I would say most of the bullishness should be probably on Monday, because we need to pump up the market as much as we can on Monday before it can continue to fall down for the rest of the week. And so this is, we got a busy week ahead of ourselves here. Let's get into the earnings information that I've been able to post in our featured area of our group, so we can see that this is our schedule here. I'm going to see if still waiting on some more information from the anonymous prophet, but they haven't posted it yet, which if they don't send it to me yet during our meeting, I'll definitely I'll post it later today or tomorrow, whenever they send it. But this is what we have for now. This is the schedule for this week, and again, this is pretty much the last week of the major earnings reports, because next week, the next following week is a holiday week, so it's just going to be very, very, very light, and so not much activity then. But this is kind of the last bit. So we do have Nike as the number one most anticipated earning release, followed by FedEx, General Mills, Carnival, Micron Technologies, Rite Aid, Fuel Cell Energy, CarMax, FactSet, and the Toro Company. So let's go and go through some of these. We have the Nike is scheduled to release their earnings on Tuesday after the stock market opens on Tuesday, December 20th. The company's earning release has a 61% expecting an earnings beat. Now, when we normally look at these earning reports, usually 65% is average. If it's below that, it's considered below average. If it's higher than 65%, that's considered above average. So this is just slightly below average, but still not too bad. We have the option traders are pricing in around 7 to 8% price movement on this, and where it normally moves around that. So it is a pretty volatile, stock. FedEx is scheduled to release their earnings on Tuesday after the stock market closes, Tuesday the 20th. The company's earning release has a 36% expecting an earnings beat, while option traders are pricing in around a 6 to a 7% price movement. FedEx is this is very sensitive time, because they're this time of year, it's a holiday year. This is probably the peak business time where they just have a lot of but there are still some driver shortages, as well as the truck shortages. I don't know if you've seen lately, but FedEx or UPS and some of these mail carriers are driving around U-Hauls because they don't have enough trucks. They're not being built enough. Because there's still a shortage on automotive parts, metal materials, and microchips. General Mills is scheduled to release their earnings on Tuesday morning before the stock market opens on December 20th. The company's earning release has a 76% expecting an earnings beat. Option traders are pricing in around a 4.5% price movement. But a picture can say 1,000 words, and sometimes one company owns a lot of stuff. So it kind of gives you an idea of what's behind General Mills. Carnival is scheduled to release their earnings on Wednesday morning before the stock market opens on December 21st. The company's earning release has a 59% expecting an earnings beat. Option traders are pricing in around a 10% price movement, and normally Carnival is pretty volatile, so there's a lot of people who are going to be really focusing on this one, as well as many other cruise lines, because with what happens with one volatility, it can affect the others. Just like Micron, for example. Micron is scheduled to release their earnings report on Wednesday after the stock market closes on December 21st. The company's earning release has a 56% expecting an earnings beat, which is not good. Option traders are pricing in around a 6.5% price movement with this, which can also lead volatility with other semiconductor companies like AMD and Nvidia. Rite Aid is another one that Rite Aid, before the pandemic, Rite Aid was on the verge of going bankrupt or filing for bankrupt protection and stuff, and then all of a sudden we had the pandemic, and they wanted to close they closed the economy down for the second quarter of 2020, and except for essential businesses, they left open. So this was a very desirable business during that time, as well as a great place to maybe get your COVID tests. Because you can just drive up to the window and do it all there right in your car and whatnot. And so, but it drove a lot of business to Rite Aid, and it kind of postponed their, getting, going bankrupt and this and that, whatnot. And so, but that's all over with. So it's like to be continued. And so, just be prepared that, because Rite Aid, which is confirmed to release their earnings on Wednesday morning before the stock market opens on December 21st. Even though the company's earning release has a 67% expecting an earnings beat, option traders are pricing in up to a 20% price movement in either direction. So there's just a lot of volatility with this thing. It's just hard to imagine that it would be in the upwards position. But either way, this would be a great one to straddle because of the anticipated movement. Now, straddling earnings is considered a lottery play. We don't want to go heavy on lottery plays because of if it doesn't move, or if there's a glitch that I call, where a glitch could be like, what if they leak the earnings report early during the market hours? And all of a sudden we see this massive volatility, whether it goes up or down. But usually by the end of the day, it resets itself back at like 0%. And then you go into the next day, you know, if you're still holding, it could be affected by what's called IV crush or implied volatility crush. That will devalue both your calls and puts at the same time, because you know there wasn't any price movement after the earnings report. And so that's why we always go light on anything that has to do with a lottery plane. But you know, they can provide a massive amount of opportunity, and that's why, you know, this is kind of a you know, high risk, high reward type of strategy. But that's why it's important to try to know what's going to happen before it happens, because that gives us an advantage over everyone else. Fuel cell, this is another, I think it's still a penny stock, isn't it? We used to trade these back in the day. And so Fuel Cell Energy is confirmed to release their earnings report on Tuesday morning before the stock market opens on December 20th. The company's earnings release has a 53% expecting an earnings beat, while option traders are also pricing in around a 16% price movement. So we're also expecting a lot of volatility with this one. CarMax, you know, the used car industry is just recycling itself, you know, and the only way for an automotive company to really maintain growth and profitability is being able to sell both new and used, especially if it's a new vehicle that's a specialty vehicle. Dealerships are marking those up $5,000, $10,000, $20,000 over MSRP. Plus, they're getting fresh trades where they can make a significant amount of money on as well. So CarMax, which is just a used car place, they're just they're paying a lot for vehicles and trying to just quickly turn them over, and so. CarMax is confirmed to release their earnings on Thursday morning before the stock market opens on December 22nd. The company's earnings release has a 7% expecting an earnings beat. 7%. Option traders are pricing in around a 14% price movement in either direction. So this is a huge opportunity, and it creates a lot of certainty as well that it's going to go down 14%. FactSet Research Systems, which is scheduled to release their earnings on Tuesday morning before the stock market opens on December 20th. The company's earnings release has a 58% expecting an earnings beat, while option traders are pricing in around 5% price movement with this earnings report. Last but not least, the Toro Company. Again, if a picture can say 1,000 words, sometimes we don't always know what the company is just by looking at the logo or the company name, but we can see that they specialize in lawnmowers and other types of similar equipment. But the Toro Company is set to release their earnings report on Wednesday morning before the stock market opens on December 21st. The company's earnings release has a 78% expecting an earnings beat, which is considered above average. Option traders are pricing in around a 6% price movement on this. Normally it moves, actually doesn't normally move, hardly any, but 2%. This is what I'm waiting for as well. I don't have it yet, but again, I will be posting the anonymous profit as soon as it becomes available. It's being developed as we speak. And then so the other thing was, again, the economic reports. I kind of posted it using my my phone, and so, but I kind of color code it sometimes too, letting us know that, you know, that this should be a bearish forecast. So bearish is for red, green is bullish, and then bullish. So this gives us kind of an idea using color codes. Are we bullish these days, or are we bearish? Yellow, because it's the same, you know, it's mixed, you know, to be determined, you know, really need to watch it close because it could either provide bullish or bearish characteristics. And So I have these saved in our little featured area of the top of our group for our reference. Now, it's also important where, let me see here, thought I'd saved it in here, refresh it really quick, but the investing.com's top 5 things to watch for this week. As we do our due diligence, it's always good to look at this just to make sure we didn't miss anything. So in the week leading up to the Christmas holidays, the economic calendar is quieting down, with the Bank of Japan the last of the major central banks to hold a meeting this year. The United States data on housing and consumer confidence will give fresh insights into the strength of the economy as recession fears wane. The prospects of a Santa Claus rally have dimmed as investors fret that the Federal Reserve's aggressive policy tightening will hamper growth. Here's what we need to know starting our week. The Bank of Japan, which I already mentioned, is number 1, and so usually they provide this kind of in a severity level. So it's very interesting to see that investing.com put Bank of Japan on their top of the list. So it says the uber dovish Bank of Japan is widely expected to stick with the negative interest rates that have set it apart from its global peers at its final meeting of the year on Tuesday, despite rising inflation. The annual rate of inflation hit 3.6% in October, which was the biggest increase over 40 years, driven higher by rising energy and food prices, while high inflation in Japan is still well below the levels seen in the United States and Europe, and the economic recovery remains fragile. The Bank of Japan governor is due to step down in April after a decade at the helm, and major policy shift is seen as unlikely before then. Meanwhile, inflation data for November is due out on Thursday and is expected to show another uptick. So this will just help provide maybe some, more volatility for that day, but it was not on our, because it's from another country. So the number 2 was the U.S. data that we kind of went over. So that's major. 3, which says stocks is the United States stocks fell for a 3rd straight session and suffered a 2nd straight week of losses on Friday, as fears continued to mount that the Fed's aggressive tightening will tip the economy into a recession. For the week, the Dow Jones average dropped 1.6%, while the S&P shed 2% and the Nasdaq fell just under 3%. Wow. The Fed delivered a small 50-point basis point rate hike last week, but flagged there were more increases to come. And again, like I mentioned, they already have it scheduled for the first week of February and the second week of March. So that still seems aggressive to me. I don't know what you think, but even if it's still, and a lot of the enthusiasts think it's going to be another 50-point basis for each one. So that's a 1% increase for the first quarter. And so says point rate hike last week, but flagged there were more increases to come, projecting that the increase or the interest rates would top the 5% mark in 2023, and a level not seen since 2007. I don't think so. I think it's going to be higher than that, because that would mean that they would be done with interest rate hikes for the first quarter. I mean, wouldn't it? And so I think, I think they're going to do more, because I don't see where things, but to be determined though. I mean, we have to put a lot of these clues in place, because all the stars will align when we do this. And like I said, the first quarter is the bearish, is really the bearish season. It's the winter. Winter is coming, and so this is where we'll see the majority of it, and it'll begin to dissipate during the second quarter. So things will start to kind of maybe flatten or range. It's the transitional period from going from our bear market to a bull market. Now, a lot of enthusiasts are thinking that this is going to last for a couple more years. No, it's not. We always stick to the cycle because that is it's always right. It's always right. It's always accurate, no matter what anybody tries to manipulate or what the media is saying. And so we always want to follow the economic cycle. And I can show that to you guys if you want to see what the economic cycle looks like too. But let's finish this up here really quick. So number 4 was Eurozone, and then number 5 was the United Kingdom. So yeah, so just know we're expecting a lot of volatility. But let me upload the economic cycle here for you guys really quick, because it's just good to just as a refresher to kind of take a look at it, and or if you don't have it, you can also download it. So I'm gonna upload this to the Learning Center chat room really quick. I'm just looking for it. Just give me a moment here. Oh, but yeah. So the stock market has a yearly cycle, normally where where we have usually 6 months where we see some bullish characteristics, and then the next 6 months we see some bearish characteristics. However, the stock market or the economy also has a 10-year cycle. 10-year cycle where we usually see where the whole economy has reached its high points as well as its low points. I'm going to do another one here too. So I uploaded that one. I'm going to show you something else too, which is also very critical. The Learning Center in our chat room. Let me find our chat room here. Let's see. Learning Center here. Okay. So this is the economic cycle, and so we talked a little bit about the GDP growth. The percentage. Part of it. It was saying like 2 point something or other. We're also in that 3 point whatever. We're over here basically, and so this cycle, as you can see, as we go forward, it starts over, and then it just keeps going. This is our 10-year economic cycle. Now, sometimes it can happen. It can reset itself sooner or later, but it repeats itself, and so that's why it's so important to know all this stuff, and that way, and because the Wall Street has the same information. You have all these other major politicians, the Pelosi's, they have the same information, and so it tells us, like right here, it says sell financial, housing, retailer, auto stocks. We were just talking about how automotive sales are declining, home sales are declining. Sell financial, those are banks. They have high interest rates. Nobody's getting loans anymore, and so this is saying to have sell up because they're going to continue to go down. And then it's buy metals, minerals, stocks, metals, because there's a short supply in them, and there will be continue throughout that process. So, and then it also says here, it points out more activity like the tightening. Fed begins to tighten the interest rates. There's a second rate, third, fourth, and so on. But now we can see where it starts to change, and now we have easing. Easing is probably going to start happening, with the rates. They could start happening mid next year, or maybe 2024. The beginning. It just really depends on where they want to put themselves within this cycle. But it will repeat itself all the time. But like I said, it could be between 8 years and 12 years. The other thing that I want to point out as part of this cycle is that the world leaders like to provide a massive amount of volatility when we reset the market or the economy. And so I saw this on Facebook several years ago because somebody was trying to point out, just stop watching the news and listening to all the drama. Just live your life and be happy. And don't worry about anything. But I look at this differently. As a lot of us are traders and investors, we look at things differently because we're always looking for opportunities or how it will affect our economy or the market. When I saw this, I was like, oh my gosh, I remember every single one of these years and how it affected the stock market. Now, every 10 years, again, they'll come up with a major one that will provide a massive amount of volatility. And so, like the year 2000 was the Y2K was going to destroy everything. You know, we thought that the computers were going to crash. We thought that the power grid was going to go down. They even had commercials or videos of people checking their bank account after midnight on New Year's, and it was $0 in their bank account, or they checked their bank account and they had millions of dollars in their bank account. I mean, they just pumped up with so much uncertainty. But all they needed to really do was a computer update, because really the date would have reset back to the 1900. It would be 1900. They just did a computer update so that way it would just fix the clock system. But it just provided so much craziness with the stock market. But in 2001, we had the anthrax is going to kill us all. So every bearish season, they come up with something mild. That way they can try to create fear. And so with the anthrax thing, they were mailing, they were saying that people were receiving letters or packages in the mail. If it had white powder substance, call the FBI or your local police department, whatever. Well, one day it was on the news that the Wall Street had a mystery package that had that in there. They had to close it down and whatnot. So it just provided a lot of uncertainty and scares, and it provided some mild bearish characteristics. But so did the West Nile virus in 2002, SARS 2003, bird flu in 2005, the E. coli virus in 2006. And then it was due for the reset. There was a new cycle that we had to start over in 2008. That was the housing, the financial collapse, with the banks and the housing and the automotive. And so they needed to be bailed out. These banks started buying each other. I mean, there was a massive amount of bearish characteristics for a long time, and so they needed to do a lot of things. But that was the reset time. That was the new beginning of the economic cycle. So then 2009 we have the swine flu. Then we skipped a couple years, went to 2012. The Mayan calendar predicts the world was going to end. 2013 was pretty aggressive, with North Korea is going to cause World War III, because they're always launching missiles. They just really zoned in on that the most. I mean, they're always launching missiles a year after year. Nothing is new. And so, but 2014, the Ebola virus again, they used the same one because, they're running out of ideas, And so 2015, ISIS is going to kill us all, blah, blah, blah. 2016 was the Zika virus. But then we had, a different kind of, president that liked to, not so much utilize this type. Because you will notice with these types of excuses seem to come more from democratic politicians or media and whatnot, not so much Republicans. Republicans seem to do certain things a little differently, but this is more fear tactics to help create volatility rather than doing other things. But 2020 was the coronavirus. They had to shut the economy down, which is interesting because we knew that the coronavirus was out there in December of 2019, and then we continued to go on into throughout the first quarter, and it seemed like the world leaders wanted just to finish the first quarter off as strong as they could before they closed the entire economy down for the second quarter of 2020. And so but during that time, they caused the stock market to plunge. But at that time, once it started to hit these low points, and keep in mind, we watch oil reach under $1 a barrel, and it's been up as high as $125 a barrel when Russia invaded Ukraine. But now it's right around that $70, $75 a barrel. But it's still a lot more than $1 for what they paid for it. So they had this event called quantitative easing. That is when the government starts buying billions and billions of dollars worth of stocks. They had a schedule of when that was going to take place. I called that our pump days, because we knew what days that they were going to be. They weren't that often compared to now with the quantitative tightening, but these were, a day that took place, once a week or once every, a couple weeks. But they happened early in the morning. They were very, very predictable. We buy just strictly calls the day before, and they would double the next day. I mean, it was amazing. But now we have what's called quantitative tightening. But the neat thing about these is that there's a schedule. It's hard to find, but once we have it, it's a gold mine. And because we know what days that they're going to sell, which now I call our dump days. But when they do dump their stocks that they bought during that time, we sometimes it doesn't happen early in the market during pre-market. It could happen during pre-market, but it can also happen during the middle of the day, or it can also happen as late as 1 second before the after hours market closes. So that makes it look like it doesn't even affect that day at all, but it will significantly affect the next trading day. So what was the fear of 2021? So the fear of 2021 was maybe that's still part of the corona thing, I can't remember, but the fear of 2022 was the inflation fear, and then going into 2023, I believe they're calling it the recession fear. So, but to be determined. Every year it's going to be something else. It's just a matter of what is it going to be this time, and when is it going to be the next big one. So, but just know the next big one, it's always going to happen between 8, 10, or 12 years. And so we're a long ways from that. We're almost over the little hump there, where again, here in about 3 to 6 months, we're all going to see the light at the end of the tunnel, and things are just going to start getting better, as long as there isn't a World War III or something catastrophic. But talking about the quantitative easing and quantitative tightening and the calendar, again, that is available to us using the Federal Reserve Bank of New York website. If we go over down here, we can see the schedule here is available, and again, so today is Sunday the 18th. The next one is going to be Tuesday the 20th, and then we have Thursday the 22nd. So by looking at this date, and then over here we see the par value, we can see that this part basically means that on Tuesday the government is scheduled to sell $3.6 billion worth of stocks. But this Thursday, they're also scheduled to sell another $3.6 billion worth of stocks, which is actually pretty light compared to the normal Thursdays. Are usually, very, very significant. So this is very interesting that they're going light this week compared to next week, Thursday. $19.2 billion worth of stocks, just trimming the fat off the market, and that's a huge. And so this can provide us a severity level of how much volatility or bearish characteristics, because this is definitely bearish. But again, we just don't know. Are they going to sell? Are they going to execute this order during pre-market? Are they going to execute it during the market hours, or during after hours? So if it does after hours, that means it will affect the next trading day. So for example, if they do execute this order on Tuesday during after hours, that means it will affect Wednesday morning during pre-market and after the market opens. And so it's important to be determined, but at least we are aware of these scenarios because there's only so many. they got to pick one. And so, unlike the pump days, it was always in the morning, because that Donald Trump was president at that time. He was he'd always give us clues what to do. It made it very, very easy for us traders and investors to make a lot of gains. But with the Biden administration, he don't care about the stock market. He doesn't look at this as part of the economic growth. He believes in the cycle. And so that is, like I said, this is very, very, very important stuff. So also, when it comes to scheduled events, it's also important to know when the president or the White House is going to say something, because that does provide also a lot of volatility with the market. But we don't usually get a heads up notice, like a week notice. We get a 24-hour notice, or if that, because when it comes to the president and the White House, things those guys have a very busy schedule that are always changing. And so, but at least their schedule is released to the public every midnight Eastern time, or at 9 p.m. Pacific time, which gives us, those that are on the West Coast, an advantage, because at 9 o'clock p.m. a lot of us are still awake and whatnot. So we can just go to this website, Joe Biden's president public schedule, and to view. But it's important that you are also aware of the times. These times are based also on Eastern time. So based on your time zone, you just have to kind of do a little bit of math to determine what time that they are scheduled to speak. And the best place that we go to find these live videos is on YouTube. But it's important to try to start locating it 15 minutes before it's scheduled to happen. So for example, let's see. So here's one here last Thursday, the 15th. It says right here, and it's in a green, it says press briefing, but it says press briefing, and it could also show us or give us some clues of what they might talk about, and that could provide us maybe some information that could provide bullish characteristics or bearish characteristics. They start talking about COVID, obviously it's probably going to be bearish characteristics. And so, because we have to determine are they going to scare investors, Wall Street and whatnot, from what they're going to say, or maybe it says maybe they want to talk about the economy. They could, and if they start mentioning company names like Ford Motor Company's building new factories, they're going to employ 4,000 new employees, blah blah blah, after they just let go a bunch of other ones. But these are just things that will encourage investors in Wall Street to buy, and so so we could see a little pump action with that. And that's why it's also important that we listen in as it's happening, because the news companies, I mean, they're doing it too. They're listening, but they're gonna be very selective and only display certain parts that they want you to see minutes, if not hours, after the event took place. And at that point, the market has already reacted to what was going on live. So that's why it's important. We are like the journalists. We need to know what's going to happen. We need to watch the events playing live. When the journalists start asking these questions about certain things, they're almost the same questions that you or I would ask if we were there. And so, because these are questions that help provide us, information about, what the economy is going to do now or later. And so that's why it's just really, really important to know whether these are going to be scheduled or not. And now, if we find something where there's no schedule, then we know that they're not going to affect the stock market that day. And these are usually scheduled, either in the middle of the day or right before the market closes. So we have the economic reports that affect the morning, and we have these politicians that affect during power hour. And so that's why it's important to know all these times. But once you get them down, I mean, you'll master them, and you'll, it's just very, very important. can't say it enough, but these just provide a substantial amount of volatility throughout the day, and so it's only important to know what's going to happen before it happens. And so let's take a look at some last week's stock options activity. So on Friday, right at close, Tesla had dominated the lists. Tesla, which is struggling, ever since it acquired Twitter and providing some drama. It's caused a lot of Democrats to sell Tesla stock, and plus, Elon has said things that have kind of maybe offended other people, and so he's losing his fan base, basically. But he's still a very smart guy. Never want to underestimate him or Tesla, because they always do things that wow us. And so, but they were significantly down, almost 5% last Friday. They had 3.3 in options volume, but out of the options volume, the put and call ratio is nearly 50-50. So there's a lot of people straddling Tesla going into Monday. Apple was second place at 1.8 million in options volume, but it also fell 1.5% down to $134.51. Options volume is also nearly 50-50 when it comes to its put and call ratio. Amazon was third place, like always. These guys are always in the top three with 1.5 million in options volume, but the put ratio is nearly 65% with a 35% call ratio. So that's definitely very significantly different. Facebook, or Meta, which has been doing pretty well lately. I'm sure it's taking advantage of some of the Twitter drama, but Facebook is now up to $119.43 a share, and was up just under 3%, but has almost a 50-50 call and put ratio. Unlike Nvidia, though, which was down $165, has about a half a million in options volume, but its put ratio is about 60%, while it has a 40% call ratio. Though there are a few very unusual activity here that we see, and normally when we're looking at this stuff regularly, we know what's regularly on here and what's not normally on here. But when we see something like Starbucks that's not normally on this list whatsoever, all of a sudden is. And it was down only 1%, but its share price is down just under $99. But out of this amount of unusual volume for Friday, we have a 93% call ratio. 93%. That is highly unusual, because normally we see 50-50, 60-40, maybe at most 70-30, but 93%. And it's nearly on the top of this list when it's never normally on this list, even on the bottom of the list. Something's going on here. Alibaba, which is usually on this list, but we're starting to see a little bit more towards the put side, about 72%, where its call percentage ratio is about 28%. AMD, which is about 60% puts and 40% calls, going into this next coming week. Ford Motor Company is about 40-40. Netflix was about 60-40. Google, a little lower on that one. On the one of them has 70% put ratio on almost 30% call ratio. So a lot of really indifferent ratios here, but a majority of them are very bearish. But the top ones, most of them are 50-50, except for Amazon. Going into this next week, I would say the majority just are not sure what Monday is going to be like. So they're not risking it. They're going in 50-50 calls and puts, because you know, when we buy our straddles, we can buy them 5, 10, 15 minutes before close, but we can sell them either at the same time the next trading day or at different times. That way we can try to maximize our gains on one side while minimizing our losses on the other side. And sometimes we can gain on both sides just by selling them differently. You know, if the market was open in the green, we would sell our calls first until once we got, you know, the right, you know, sell signal as the market began to come down. And then all of a sudden, what if things got turned into red? Now our put, which was in the loss, is now in a gain. So now we just gained from our call and we'd gain from our put, and it was just a huge win, you know, altogether by utilizing moving averages for our buying and selling signals. And so it's a lot of interesting activity here, but we can also take a look at the option volume leaders. This is going to provide us the most active individual calls and puts. But some of them are going to be expired. When we're looking at the DTE, which means the days until it's expired, we can see there's 0. So these no longer applied because they're expired. But out of every single individual call and put, we have a $110 Starbucks call strike price that expires next March 17th, which is approximately around 90 days from now. But not only do we have that, but we also have a $105 call. We have a $115 call, all right up here. There's a lot of calls activity going on with Starbucks for some reason. There's a lot of open interest, so this may have been something that's been accumulating, as well as Thursday and Friday. But yeah, we see a lot. Well, at least we see this one that has exceeded over, which is always good to see. So going into Monday, we'll need to take a look at Starbucks again to see how it has accumulated more open interest, because it may be on the highest open interest on the list, which we'll take a look at here in just a little bit. So we have Starbucks there, we have Apple, we have an Apple put, which is very interesting because it's already in the money, but it has a very far out expiration date. But there's a lot more volume that exceeds over the open interest. So that's very, very unusual right there. That's got to be very expensive. Look at this. Wow. I mean, each call put is what, like $6,000. My goodness. So that's just very, very unusual what's going on there. There's a Google put right here, $130. That's already in the money. That's very unusual. There we had a Tesla $160 call going into this week. A few Amazon puts. These are already in the money. My goodness. A lot of wow. I mean, yeah, like I said, this is just really, really bizarre. Rivian. We have a Rivian put, $20 put right there, 35 which expires January 20th. It's got a lot more interest on it. Got a lot of volume there. Amazon, got some Amazon puts. That one's already in the money. Ford Motor Company, that one's already in the money. And it's just got a lot more people buying into them. Yeah, that's just really, really weird. But very. It's always good to know. This information does update throughout the day when we're looking at it on Bar Charts website. But it's also important as a reminder to always download the NASDAQ's trading calendar. Now we're in December right here, so as a reminder that Monday the 26th is a holiday, so the stock market is going to be closed that day, so there's only going to be just a few days of trading on the last week of December. So again, it's just going to be very, very light activity. There's not going to be a whole lot that's scheduled to happen. It's going to be very, very mild. And so, but we'll look more into that, later. But hopefully this information has helped everyone. Anybody have any questions, anything anybody wanted to go over or to provide, feel free to unmute your mic if you wanted to say something. If there's no comments or questions or anything, we'll be assuming everything makes sense. You guys are ready to rock and roll. All right, guys, this was great. Again, we won't be able to do this next week because it's a holiday week, but we can always try again. Well, even the week after that, it's another holiday week, so really we've got 2 holiday weeks. So, but yeah, anytime you guys have any questions, just hit me up on Messenger. All right, guys, have a a good day. Let's trade. Let's make a lot of gains next week. Make good choices, and if you have any questions, just message me on Messenger.